This side Rahul Magan here is a Group Chief Executive Officer, Treasury Consulting and also a venture capitalist. Now standing today, we're going to talk about something which is actually happening and which most of the people do not know. India is a country where I always raise a voice, people like or do not like, that is their personal problem, is that people do not have financial literacy. I always say that literacy holds two components. Number one, which is you able to speak English, you write English, you can read newspaper, you can read magazine, you can see what's happening on the TV channel and you can make your comment out of it. Another literacy is the interpretation, how you interpret the thing. Einstein, I always have deep respect to Einstein. He always said a very beautiful line that knowledge is imagination. And one of the most important things he said that a knowledge is not all about knowing something, it's all about making something new out of it. And we thank you to Einstein sir, to who literally left a very great legacy for young guys. When it comes to mutual fund in India, or when it comes to that financial literacy factor in India, the knowledge is absolutely zero. That is the reason the circulation of the best magazines in India is almost zero. People don't read that. Before buying a magazine in India, people look at the cost. And before buying a pizza or maybe a chole bhature or maybe any fast food, they never look at the cost. That's how. What happens? Mutual funds are of hundred of times. You have equity mutual funds, debt mutual funds, hybrid mutual funds, income mutual fund, SIP denominated, and now we have gold, ETFs, ITFs, and number of that stuff. Out of that category, today we're going to speak about, we have the following debt category. One is the long-term debt, medium to long-term, medium duration, short duration, and then you have short-term fund, liquid fund and all. You must be thinking that why I am referring all this. Treasury Consulting is a cash-rich company. We are not like Vijay Shekhar Sharma who always begging before our venture capitalist, We invest our surplus money before top 10 mutual funds in India. So the top 10 mutual funds in India are our client. Last time I gave you a demo that we getting a magazines from them wherein I read word to word, and it is approximately 3:30 in the morning when I'm shooting this video. One of the important category in the mutual fund is the credit risk fund. In fact, a better category in a mutual fund in a debt category is the arbitrage fund. I say the most riskiest category in the debt segment is not duration, rather it's a credit risk fund, and more riskiest out of credit risk is the arbitrage fund. So arbitrage fund is basically he take an arbitrage, he see that if I take a position today, I don't know, but it might click. But the credit risk fund is taking up a position in those companies who think that position will recover over the period of the time. And considering the markets in India, where you do not have a CDS market, which is credit default swap, well, by the way, CDS is a simplistic instrument we have, then the problem go haywire. You do not have CDS, you do not have first till default swap, second till default swap, you do not have notional swaps, you have nothing. In fact, most of the people feel that, the credit default swap is the only instrument which we have. Guys, you have equity default swap also. In US market, if your equity defaults, you can recover that. For that, you have an instrument which is known as equity default swap. I am damn sure 99% of the people heard it first time. There is something known as equity default swap. That is why US is the #1 mutual fund market of the globe. Anyways, what happened? The issue for today is in the last 1 year, mutual funds heavily promoted a kind of category which is known as the credit risk fund. And on our TikTok channel and our second YouTube channel, Treasury X, we always pushed people not to go with that. But I am not regulator, you understand. What happened? Today we decided to shoot a video that how big mis-selling it was. Like, I'll show you out. Let me compare this with I would say the liquid fund. Okay. So In a 3 month category, the liquid fund is generating a decent result. There is no doubt about that. They are generating a decent result, roughly 6% to 7% return, which they are generating. If you take 1 year category, then somebody generating 7.5 also, which is not bad. No doubt. We have one category which is known as credit risk fund, and the following are that: ABSL means Birla Mutual Fund, Aditya Birla. ABSL credit risk, Axis credit risk, Baroda credit risk, Bank of India Exa credit risk fund, DSP Merrill Lynch credit risk fund, Franklin, HDFC, ICICI, IDBI, IDFC, Investco, Kotak, L&T, Mahindra, Nippon, PGIM, Principal Credit Risk, SBI Credit Risk. Okay. If I look at the return, you would be surprised to see that in a 3 month category, someone got minus 1.3%, someone got 2%, someone got like Franklin Credit Risk Fund got minus 3.2%, which means it contracted. If I look at IDBI Credit Risk Fund, then it is 0.9%. By the way, IDBI is no more an AMC. It is bought up by Muthoot Finance. So that in India, it can only happen that a non-banking financial corporation who is raising money from outside, because they don't have the money, they buy a mutual fund from that money. This can only possible in India. Apart from that, nowhere it is possible. Like if I speak about Nippon India Credit Risk, then in the 3 months category, they returned about only 0.3%. Even if I take 3 year category, in 3 years, Nippon Credit Risk Fund generated only 4.7%. It means that if I wait for 3 years in Nippon, I will get 4.7%. Credit Risk Fund is one of the biggest mistake the mutual fund launched in India. And I do not have the whole portfolio available, but I will let you know. Just give me a few minutes. Now let me give you the asset size. In case of Aditya Birla, let me tell you this. HDFC Credit Risk Fund, which generated 2.1% for 3 months, is having a corpus of around 14,000 crores, while ICICI Prudential, which generated only 2.7%, is having a corpus of 12,000 crores. Rest all are having corpus less than 1,000, few are having 5,000 crore corpus also. So what I wanted to say is that the credit risk fund is not a suitable strategy in India. The matter of the fact is that it is not a suitable strategy because you do not have a CDS market in India. And until we have a CDS market in India, investing in credit risk fund is like playing a cricket match without having proper gears, or jumping into the sea without having swimming shoe. When I look at the US, the situation turns, and it turns completely. So I open and I create Credit Opportunities Bond Fund by PIMCO. I hope I need not to tell you that PIMCO is the largest hedge fund of the globe, founded by, I call him Sir Bill Gross. He's a great gentleman, by the way. Now, if you use this, you would get to know that how much return are they generating and how flexible that fund is. See this. PIMCO Credit Opportunity Bond Strategy uses a global approach to credit selection while focusing on general attracting, and what kind of fund it is taking, I will show you out. It invests in, wait a minute, it is coming, here we go, yes. Yes. No, here we go. Yes. PIMCO top-down investment process anchors our bottom-up relative valuation and therefore firm global economy and PIMCO Credit Opportunity Fund. and it invests in the floating income strategies, foreign bond strategies, global advantage strategies, global bond strategies, global real return strategy, municipal strategy, high yield strategy, and all, and long duration credit risk strategy, long duration strategy, more moderate duration strategy, and more importantly, such funds are actively investing in mortgage LIBOR plus strategy. That is where they need to take a call once SOFR come, then how it would happen. To cut the long discussion short, we really need to see that when we talk about the credit funds, there is nothing wrong in credit funds. Let it be honest. There is nothing wrong in credit funds. Credit funds are always good. But what is wrong in these funds is that until you have the CDS market, you will never grow. You need a CDS market in India to get it grow, and India do not have a CDS market. Credit risk funds are applicable only in the country like US and suitable to the people like PIMCO and Vanguard, those who can access any country credit derivative market, and more importantly the country in which they are sold, which is United States. It is one of the deepest CDS market we have in the globe, because CDS buyer and CDS seller are available. I'll show you one more demo and then we wind up this video. Like if I show you the debt credit risk, it is Sundaram ST credit risk and UTI credit risk. See this. UTI credit risk generated, first of all, UTI credit risk is around 1500 crores of folio, and UTI credit risk generated around 10% negative return in 1 month, 3 month category, and 15% return in 1 year category. So if you would have invested in a UTI credit risk fund and you waited for 1 year, then your portfolio would have contracted by 15% for getting a return out of that portfolio. So credit risk is not a right strategy in mutual fund. More importantly, Indian mutual fund do not have an alternate portfolio, so which I am going to show you about. Like see that. India do not have a kind of mutual fund category which US have, and this is can only offered by US, like I am giving you a Blackstone. So Blackstone offer an alternate strategy. Now what they offer in Blackstone, this is what they offer. Number one, in that alternate they cover private equity. Blackstone is the number one private equity player, there is no need to tell that. Number two, it covers commodity, which covers index funds, commodities funds, future based commodities fund, and commodity indexes. Third, it covers the real estate direct ETF. So we have two kind of ETF. One is exchange traded fund, RMBS, residential mortgage backed securities. We have exchange traded fund, CMBS, commercial mortgage backed securities. Then we have REITs, which is real estate investment trust. Here Singapore is number one as far as Asia is concerned, and US is number one as far as globe is concerned. Now in this alternative fund strategy, you will see that alternative fund strategies are most liquid, number one. Of course there is an exit flow, much better than credit risk, complete exposure, not thematic in nature, and more importantly taking a wide exposure of the whole economy. But sitting today, even in 2020, Indian market do not offer alternate risk strategies, or any mutual fund in India do not offer alternate strategies. That is the reason even people, those who read such magazines and do not compare this with the US market, example, I have, in the interest of time, I have gave you only Blackstone. We have BlackRock also. We have multiple players, KKR also, we have lot. PIMCO, Vanguard and all. If you would have compared the alternates of US compared with the alternates of India, India is not offering that. And more importantly, most of the people in India in fact do not know that how alternate look likes, how to devise an alternate fund, what percentage composition we need to make, and so on and so forth. This is what we need to tell you, that how alternates are actually devised. Alternate is very important for the globe. Credit risk strategy is not bad. It is a good strategy, provided that country having a serious market, which India do not. Third, credit risk strategy is not in case of falling curve. India credit curve is falling. Credit risk strategy is a suitable strategy provided the risk curve is not falling. But here the risk curve is rising. So is not falling. So here it is falling. In US it is more or less a flat. So here it is a good opportunity to get this done. With this we thank you very much. The purpose is to let you know that even if you have these kind of magazines, those who provide a lot of data which cost 150 rupees, and Treasury Consulting is a subscriber of that magazine from the last 10-12 years, and now we are launching our own mutual fund across the globe. But unfortunately, if you compare these magazines with the kind of mutual funds we have in US, specifically BlackRock, Blackstone, PIMCO, Vanguard, you will Janus Henderson, and the list is long, you will not get the appropriate information, and you feel that the world is very small. With this we thank you very much, and you know my mobile number, which is +91 9899242978. You know our fixed income platform, www.fixedincome.global. Have a great time.